Hey everybody, my name is Paul Vacheski and welcome to the Real Estate Classroom YouTube channel. Before we get to today's video on the types of loans in real estate, do me a favor, give this video a thumbs up, hit that red subscribe button, click on the notification bell, and if you have a comment or question, please put it down below in the comment section. So let's get to today's video. So in today's video, we're going to discuss three different types of loans that are out there. They are the core lending that we see in the real estate profession. And they're really important that you not only know them for the real estate licensing exam, but you need to know them for, your real estate practice as well. Now, understand, we're not going to dive into the exact details of each loan, like what are the percentage of down payments that you're going to need and percentage of funding fees and things like that, because those items change all the time. And so they're typically not asked on the real estate licensing exam. What I'm giving you is the things that you need to know for the exam, and they're relevant to the profession as well. But the three types of loans we're going to discuss is what we call the Veterans Affairs Loan, and that is typically called a VA loan in the industry. We have the Federal Housing Administration Loan, which is commonly known as an FHA loan. And then we have conventional loan, which is basically everything else. Now, when you get into the industry, you're going to learn that there are probably dozens of other minor loans, state-funded loans, and things like that. But we're not going to talk about those, and typically the test doesn't ask you about those. So we're going to stick to the three major loan types that you're going to need to pass your exam. Now, the first one I want to discuss is what we call the Veterans Affairs Loan, or commonly known in the industry as a VA loan. Now, this is for eligible veterans. And again, I'm not going to go into the eligibility requirements because there are literally dozens of different scenarios where a veteran can qualify. So I'm not going to go down that road. But there are some things you need to know. I outlined 11 different things that you need to know. The first one is this is the no down payment loan. It's one of the best loans that's out there. The veteran literally can show up with or put zero money down to qualify as long as they're within their limits. Now, the VA guarantees this loan. You have to know that for the exam. VA guarantees loans, and when we get to the FHA loan, you're going to learn that it's an insured loan. But VA guarantees the loan, and it guarantees the top 25% of the loan. And that's based on what we call the eligibility limit. And if you go to number 4, there's what we call a certificate of eligibility. And that certificate of eligibility is given to the veteran from the VA, the Veterans Affairs, and it will establish what the limit is. And let me explain that. So right now, and you don't have to know this for a test, but right now, as of the date of making this video, it's about the eligibility is about $120,000. So we take that entitlement amount, that's what they call that, $120,000 is the entitlement amount, and we multiply that by 4. So that means that the veteran, if they qualify, by income and those in debt ratios and whatnot, they're going to be able to borrow up to $480,000. All right. Now remember, the VA, they guarantee the top 25% of the loan. So if the veteran wants to purchase a $400,000 house, that means the VA is going to guarantee that lender the top $100,000. So if the veteran defaults, then the VA is going to guarantee that $100,000 to the lender. So it ensures that lender can then sell the property and recoup their losses. So that's the great thing about the Veterans Affairs Loan. Now, the borrower must use a VA-approved lender. The VA does require the lender to have certain qualifications and criteria or meet certain criteria before they can get on the approved list. Number 5, there's no MIP or PMI. Now, MIP stands for Mortgage Insurance Premium, and PMI stands for Premium Mortgage Insurance. And they can be upfront or on a monthly basis. But another great thing is because the VA is guaranteeing that top 25%, essentially the lender is only making a 75% loan to value ratio. So therefore, the PMI or the MIP is not going to be required for this loan, which again saves that veteran some extra money. We're going to talk more about MIP and PMI later in this video. There is a funding fee that the veteran has to pay. And again, it changes all the time, so you don't have to know the amount. As of the date of this video, it's at 2.25% of the amount that's borrowed. So if you borrowed $100,000, that means $2,250 is going to be what the funding fee is, the Veterans Affairs funding fee. And that money goes into a pot of money at the Veterans Affairs to offset defaults. So if there is a default, because remember, VA guarantees these loans, then there's money to pay those defaults. Now, if you're working with a client that's a VA buyer, ask if they're disabled or not, because if they have a veteran's disability, then this funding fee is waived. All right, so make sure you inquire about that. Number 7, VA appraisal. There's going to be an appraisal that's required. Now, it's just a run-of-the-mill appraiser that went and got the VA certification. So they are approved by VA to do VA appraisals. Now, the difference between a VA appraisal and, let's say, a conventional appraisal is the VA is going to require the appraiser to look at certain things, like maybe get on the roof and check out the roof, where that wouldn't be required on a conventional loan. Again, these requirements do change all the time as well, but the VA appraisal is a lot more strict in as far as the material condition of the property than conventional. And once the VA goes out, or the VA appraiser goes out, I should say the VA certified appraiser goes out and determines the value and says everything is good, then they're going to issue a certificate of reasonable value. That's what the VA requires. Now, there is what's called a VA Escape Clause, and I have the language on your screen here. And the language does vary a little bit depending on the locality that you're practicing real estate, but it all says the same thing, and that is that if this property does not appraise at or above the purchase price, then the borrower is legally able to void the contract and get out of the deal. It also says that if the VA appraiser identifies certain repairs that must be done, and the seller is unable or unwilling to do those repairs, then again, the buyer is able to void the contract penalty-free, meaning they get their earnest money back and those type of things. Now, one thing you have to know is if that option happens, so it does not appraise, typically what happens is the buyer and seller negotiate the difference. Now, either the seller comes down to the appraised value, or maybe they split it 50-50. Let's say that it was $10,000 under appraisal, so the seller comes down on the price $5,000, or the buyer comes up with $5,000 extra additional cash, and so they meet 50-50. It becomes negotiable, but if they cannot come to a negotiated settlement, then the deal is terminated penalty-free. One other thing to note, any inspections or appraisal fees that the buyer has paid up to that point, the seller is not obligated to reimburse the borrower or the buyer for those expenses. So keep that in mind. It's just a guarantee or a way to protect the veteran. Number 9, the VA type loans require owner-occupied 1 to 4 residential units. So you can't use it to buy investment properties for single-family houses. However, if the veteran buyer wanted to buy a duplex, a triplex, or a fourplex, that would be okay. But he or she would have to live in one of the units and then rent the other ones out. There are no prepayment penalty under federal regulation, which is cool. And then these are assumable loans. They're what we call qualifying assumable loans, meaning that if someone was going to assume the loan, and that's for assumable loans we're going to discuss in a different video, but it would have to be a qualifying assumable loan, meaning that another veteran would have to come along and assume the loan and use their certificate of eligibility. It used to be that these were called VA loans were simple assumptions, which meant that anybody could assume the loan, but that changed about 30 years ago. So now they are a qualifying assumable loan. The next type of loan I want to talk about is what's called a Federal Housing Administration loan, or commonly known as an FHA loan. There are 10 bullet points that you need to know for your licensing exam. Number one, FHA loans are insured loans. VA is a guaranteed loan. FHA is an insured loan, and you have to know that for your exam. You just have to remember the two. The good thing about an FHA loan is FHA loans were developed and created back in the 1930s, part of President Roosevelt's The New Deal. Prior to FHA loans, typically the banks required 25% down payment, which was really unachievable by most borrowers even today. And so FHA loans really provides a safety net for lower income families and borrowers, because it allows the lender to make a loan up to 97% of the home value, or the loan to value. Sometimes even more than that under certain circumstances, but you really need to know that it allows the lender to make loans up to 97% of value. All right, so the borrower must use an FHA appraised or FHA approved lender. Just not anybody can do FHA. They have to go through a certain qualification process. You don't need to know the details other than it has to be an FHA approved lender. Maybe you have seen HUD foreclosed properties. This is where, and they were really popular back in 2008, 9, 10, and 11 during the Great Recession. But HUD foreclosed properties are previously FHA borrowers. So if an FHA borrower was foreclosed upon for failing to make their payments, then it becomes a HUD-owned property. Now, HUD stands for, don't forget, it's a key real estate term, it's the Department of Housing and Urban Development. And so because FHA is a federal loan, a federally backed loan, HUD is the department that oversees FHA. Now, the borrower, number 5 here, the borrower, key real estate term here, mortgagor. You have to know these two terms. The borrower is legally known as the mortgagor, and the lender is legally known as the mortgagee, with 2 E's on the end. And I got them on your screen here. The borrower is known as the mortgagor. The lender is known as the mortgagee. That's important to remember. And it doesn't matter what type of loan it is, but those are two key real estate terms you have to know. So the borrower must pay what's called upfront mortgage insurance premium and monthly mortgage insurance premium. So that FHA borrower, yes, the bank can lend up to 97%, but there's a cost associated with that. So the borrower is going to have to pay an upfront fee, insurance premium at the very beginning or at closing. And typically that you don't have to know the value or the ratios, but typically it's a percent or 2 of the amount that's borrowed. That's a one-time fee. Then added on to their PITI payment, which we talked about that in a previous video. PITI is principal and interest. That's the money we're paying the bank back. Taxes and insurance. That's what goes into the escrow account to pay the property taxes and the annual homeowner's insurance. But there is an additional, a 5th part of that monthly payment that the borrower is making to the bank, and that is MIP, mortgage insurance premium. And it's a fee, and you can see on your screen here, it's added on to the monthly payment. Well, that is to pay that insurance because that's a higher loan value. Now, here's the thing. So keep this in mind. Once the loan to value ratio, maybe a year or 2 or 3 years down the road, reaches 80% loan to value, then the borrower can petition the lender to get the MIP knocked off the loan payment. And there's a process for that, which we're not going to discuss here. All right. So remember, MIP, mortgage insurance premium, key real estate term you have to know, is associated with FHA loans. And it's number 6, FHA Appraisal Required. Now, just like Veterans Affairs loans that require a VA appraisal, meaning the appraiser is going to go out and get the certification to become VA certified to do appraisals for VA loans, same applies here. An appraiser is going to go out and seek the approval to conduct FHA appraisals. Now, just like a VA, there's going to be that amendatory clause, as you can see, number 7 there, that FHA Escape Clause or amendatory clause that's going to be required to be signed as part of the contract. And it just basically says that if the appraiser goes out and they determine that the value is not at or above the purchase price, then the deal falls apart unless they can negotiate some kind of win-win scenario, which means that let's say that the purchase price is $100,000, it only appraises for $90,000. There's a $10,000 discrepancy there in value. So either the seller comes down to $90,000 or they negotiate it. Maybe it's 50-50 as we discussed under Veterans Affairs. So the seller comes down $5,000 on the price. The buyer puts $5,000 more in cash. They bring up the $5,000 in cash to closing. So that allows the deal to go forward. That typically doesn't happen with FHA loans, but it's not impossible. The other thing that happens like VA is the appraiser is going to go out and look at certain material condition things on the property. Now, FHA guidelines require the appraiser to look for certain things. Is the concrete all cracked up? Is there tripping hazards? Did they get on the roof? Is there exposed wiring? Those type of things. So the FHA appraiser is going to look for those things. And if they find any of those things, they're going to note them in the appraisal. And then the seller basically has to fix those items. If the seller is unwilling or unable to make the repairs, which sometimes happens, then again, either the deal falls apart or they're going to have to negotiate somehow to get those repairs done. So what you need to know basically is if the seller is unable or unwilling to do those repairs, then the deal blows apart. Penalty free. The borrower gets their earnest money back. Now, just like VA loans, the seller is not required to reimburse the buyer for any fees up to that point. So maybe there's a home inspection and appraisal fee. The borrower just gets stuck with that cost. All right. 7 FHA Escape Clause. We already talked about that. In fact, they're very similar to the VA Escape Clause. It just basically says that if the property doesn't appraise at or above purchase price, or there are repairs required and the seller is unwilling to do them, then the borrower is allowed to terminate the contract penalty free. Like VA loans, number 8, it must be owner-occupied properties, 1 to 4 residential units. Number 9, no prepayment penalties. And just like VA loans, FHA loans are qualifying assumable loans, meaning whoever's going to assume the existing loan, they have to meet all the FHA requirements before that'll happen. I'm going to do a different video on how assumable loans work, but you have to know that they are qualifying assumable. Last type of loan I'm going to talk about is conventional loans. Now, there's 2 types of conventional loans. There's insured and uninsured. So unlike VA loans and FHA loans, conventional loans are not backed up or guaranteed or insured by the government at all. So if the borrower does not have 20% down payment, meaning that the lender is going to borrow up to 80% of the value, then the borrower is going to have to get what's called premium mortgage insurance. And that is a monthly payment that's added on to the PITI part of the monthly mortgage payment that the borrower is going to make to the bank. So we'll have principal and interest, taxes and insurance, and then PMI. Now, FHA, this is a key distinction you have to know. FHA is an insured loan. FHA calls it mortgage insurance premium, or MIP. If it's a conventional loan, we call it private mortgage insurance. All right, that's the difference. There's no PMI on an FHA loan, it's MIP. You have to know that. Conventional loans, PMI. FHA loans, MIP. And then lastly, there is going to be an appraisal that's required. However, as I said before, the appraiser's less likely to go out and look for those material condition items like bad roofs and those type of deals. Repairs are a lot more lenient on conventional type loans. Now, one of the things that I would recommend when you're done with this video, very important here, so you understand how the entire mortgage, the whole infrastructure of mortgages work. If you have not watched the video on primary and secondary mortgage markets, I highly encourage you to do that. I'm going to leave a link right here to the video. Definitely check that out. And by the way, if you have not subscribed to the channel, I would definitely appreciate that. Click the little circle to my left and don't forget to hit that little notification bell. That's all I got for this video. Thanks for hanging with me. I'll see you in our next video.